Welcome to Second Take, the show that focuses on the issues behind the news. Mining has the potential to grow South Africa's gross domestic product significantly, but it needs investment flow, where currently investors are deserting the mining sector. Mining Weekly editor Martin Creamer tells us more. Welcome, Martin.
Thanks, Shannon.
Now, mining has gone ex-growth, which is the ugly anti-developmental story of 2013. Can you elaborate on that?
You know, we're sitting here courtesy of mining. This city of gold and this province of Gauteng, which Gauteng means the place of gold, was built on the fact that people found a precious metal here and they turned it to positive account. Now what's happening is that there is still more gold in the ground to be got, but we are not mining it. There are a whole lot of impediments in the way, and we see a lot of strikes on the go at the moment and social issues. Just down the road at Rand Refinery, you know, there's a capacity to refine 1,000 tons of gold. Last year, South Africa refined 167 tons. Now, no one imagined that gold, and we're just talking about gold now, you know, would deplete to that extent. And if you look at some of the industrial areas around here, if you look at Wadeville, it's really a workshop for the mining industry. And that is an indication of the sort of spin-offs. You know, you go downstream, you go side stream, you go upstream. And a lot of big cities have been built on mining, and Joburg is one of them.
Speaking of those spin-offs, mining has a significant multiplier effect which creates value in an economy.
It's that multiplier effect that you've got to go for. You know, it's more than just jobs. It's the inflow of capital. That's number one. You've got to get an inflow of capital. Now, we saw some of the big diversified majors go to London, and you said, why are you going to London? You've got Joburg. And they said, no, London, New York, the biggest accumulation of capital. Let us list there, and then we will bring capital to South Africa. It hasn't happened. And we are hit by a double whammy now, because we have problems in our industry in South Africa, mainly centered around labor, but it's coinciding with problems in the world. You know, worldwide, people are not going to frontiers when it comes to mining. They're avoiding the high-risk areas. So, you know, they're going for the low-hanging fruit. They're going for places where they know there is political certainty, you know, where the mining regime is solid, and they, at this stage, not prepared to risk areas that look dicky. And unfortunately, one of the areas that's looking dicky is South Africa. So the normal model that you have, the investment model, is at breaking point. And unless you have that investor model, you don't have this multiplier effect. Now, for every 1%, you know, of mining investment, you get a 2.5% spin-off into, you know, things like skills development, education. It's a catalyst for other industries, engineering, and you know, it promotes technology transfer, because they're always doing something new in the mining. Well, not always, not sufficiently new, but they do things that are innovative. They try to. And then also infrastructure. You know, if it's bulk commodity like coal, you've got to get it on rail to the port. And that creates a whole new set of circumstances and a whole new economy, you could say. So the multiplier effects also deal with community development to a great extent now. I mean, people are getting their ducks in a row when it comes to thinking about how they can uplift near-mine communities. Just at a time when we are not having enough investment in mining. And it's a cyclical industry. So, you know, you've got to make use of a good crisis. We're in a very good crisis at the moment, and you must make very good use of it. You must get everything ready for that upturn, and hopefully we will.
Changing track now, Goldfield CEO Nick Holland says resource nationalism isn't nationalisation. What's the difference here?
We had that haunt of nationalisation. We had a young youth leader, Julius Malema, who was promoting the nationalisation of the mines without compensation, by the way. So, you know, if you have firstly, if you're going to nationalise them properly, you know, you've got to pay the going rate. South Africa hasn't got those trillions to pay. So Julius said, no, he would not give any compensation. He would just sue, he would just take them over. Now, of course, that would just cause the stock exchange to collapse, because that stock exchange is built around, sectors like the mining. And a lot of the money that goes into mining is also pension fund money and provident fund money. So it would mean that he would be denying a whole lot of people of their pensions, which I'm sure they wouldn't be happy about. So it's a non-starter. Nationalisation is a non-starter. It's been tried in more than 80 countries and failed. We just have to go up the road to Zambia. We can see what damage it did. You go to Tanzania, more damage. So all those people would come down and tell Julius, look, Julius, we've tried it. It's useless. Don't go that route. But what people are saying now is justifiable, is resource nationalism, which really means that, you get a government wanting to do the best for its people. It knows it's got commodities in the ground that are valuable, and it wants to get the best out of them from a tax point of view, from a people development point of view, and it works towards that. And people are saying, no, we believe, a groundswell of people are saying, no, that's the correct approach. You must have that conscientiousness, because this is a finite element. Once you take it out, it's not there for future generations. So let's do the best with it.
Now tell us about the Chinese gold demand opportunity facing the mining industry.
Well, you can see now, every ounce of gold that the West turns down or sells an exchange-traded fund with gold, the East buys. And we've seen that even now with the gold price down, it's even more hectic because they see bargains. So the East is really buying. It used to be India. India was the big source of purchasing of gold coming from our Rand refinery here. Now it's China as well. And China's going beyond the 700 tons a year. It's going towards 1,000 tons a year. So that should be an opportunity for gold. We're making 167 tons of gold here, and they're buying it. People expect them this year to buy 1,000 tons. India at the same sort of level. The market is there. So, you need to get to it. Unfortunately, it's been damaged by futures and exchange-traded funds. So in other words, the investment community has come in. They've seen America in trouble. They've thought, well, gee whiz, we better protect ourselves. They've rushed into gold. They've bought exchange-traded funds and they've bought futures. Now they see America getting better, so they're selling that gold. And that's caused a precipitous fall in the price. And when you have that fall in the price, there's blood on the ground. You can see that every mining company is reporting losses. They're all reporting that they're retrenching people. And, very senior mining executives are on the streets of Joburg and other cities, because it's not just a South African issue, it's a global issue.
I saw an article that they need at least $1,500 an ounce for gold to maintain the industry.
Yeah, that was Nick Holland, in fact, who gave this resource nationalism talk at Gibbs, a very, very good one. He's given it in Johannesburg. He's now going to move to Perth, Peru, and Denver to give this to the world. And he's pretty good at doing that, because he was the first to draw attention to the problems with gold a couple of years ago in Melbourne, and then it sort of spread around the world. He's also changed the way you cost your gold, because the companies were gilding the lily, and this was creating investor enthusiasm, only for the investors to find out, no, you didn't cost properly. So now the World Gold Council has set 2 cost metrics that you have to follow. And not everybody is doing it. It's a voluntary situation, but the big companies by the January the 1st, I think, will have changed to this, where you've got all-in costs, and you reflect that by a special formula. And they're saying that in terms of this formula, you need a gold price of $1,500 an ounce. That's your sort of survival level to make a profit. And we're obviously not at that level at the moment. It's still way below. So the companies are struggling. You can see them not going ahead with projects, cutting back on capital expenditure, and that's where your multiplier effect gets very badly hurt, because there's so many industries out there that are not mining industries, but rely on mining industries for the bulk of their work. And they are not getting that work now because of this disinvestment program that's going through. Everybody's trying to cut costs and to make sure that they can live with a very weak gold price, an unexpectedly low gold price. Because as we know, the gold miners, they are price takers. They are not price makers. And that's where it becomes a very difficult industry.
Well, thank you, Martin. We'll watch this space for more.
It's a great pleasure, Shannon.
That's the Second Take show for this week. Join us again next time for more news analysis.